I would like to begin by acknowledging the traditional owners of the land on which we meet today. I would also like to pay my respect to the elders past, present, and emerging. For those who don't know me, my name is Teddy Kasasi, and I'm one of the conveners for City Taxation Discussion Group for CP Australia. Alongside Henry Kwok, we put together a session every second Monday of the month for all professionals. It doesn't matter what professional bodies you belong to, you're more than welcome to come, to share, to learn, and to exchange your knowledge and expertise in your professional field. The purpose of CP Australia Discussion Group is to provide a forum for like-minded members to exchange information and share knowledge on topics of common professional interest. CPD hours can be claimed for discussion group sessions with appropriate professional content. We believe that our discussion group is here to serve people, to solve problems, and also to support members, support professionals, support businesses, and support community, because we firmly believe together we can make a difference. Just a few housekeeping. If you have any questions, please raise them in the chat box. If we were unable to address all the questions during this webinar, we'll take them offline to the speaker. The webinar and all chat history are being recorded, and subject to the consent of the speaker, we may publish the recording and relevant presentation material via our email systems in the next few days. For anyone attending via telephone audio dial-in, if you can email us your name and the phone number you used to dial in so we can record your attendance as well. So thank you for your support, and please let us know if you have any feedback via our email, which is members@citytaxation.com.au. Also, I would like to remind you that if you're on social media, please hashtag CPA Australia, hashtag City Taxation, hashtag Together We Make a Difference, and share any insight that you think relevant and will benefit other members. So this afternoon, we are privileged to welcome Julian Chang, a partner at Gilbert Tobin, and Sophie Jiang, lawyers at Gilbert Tobin. With over 25 years experience, Julian provides the tax advisory services to a full spectrum of clients. His clients include public and private corporate groups, fund managers across various asset classes, consortiums, and joint ventures, and high net worth individuals. Working across various transactions, he advises on merger and acquisition, including tax due diligence, initial public offerings, restructures, cross-border investment, funding, and fund establishment. Julian has also represented clients in audit and reviews with tax authorities, including submission to tax authorities. His advice covers matters including Division 7A, control foreign company rules, superannuation guarantee charge, the characterization of gains as revenue or capital in nature, and withholding taxes. And Sophie advises on income tax and employment tax, superannuation guarantee, fringe benefit tax, PAYG, withholding and payroll tax. She has experience advising on tax aspect of fund formation for venture capital, private equity, cryptocurrency, debt and real estate funds, employee incentive plans, and M&A, including public market, infrastructure, private equity, corporate real estate and distressed transactions, as well as foreign investment into Australia. Sophie advises clients across all sectors, including funds, corporates, public and private, family groups, and foreign investors, providing assistance with tax structuring, tax due diligence, ATO early engagement, and ruling requests, and the drafting of tax-related documentation. So please welcome Julian and Sophie.
Thanks, Teddy. I might kick off today's session. So as Teddy mentioned, Julian and I are from Gilbert and Tobin's tax team. And as part of that, our practice is quite broad, as Teddy mentioned. But today we thought we would focus this session on a brief refresher on employee incentive schemes and structuring for professional services firms. Hopefully that might be relevant for potentially your clients, as we're seeing this is an area that a lot of clients are focusing on at the moment, but also potentially also your own businesses, because as you know, we are all sort of people-centric businesses, or with our sort of key concerns with employee retention, incentivization, and so on and so forth. So I might just... So during today's session, what we will focus on primarily is sort of employee incentive schemes, the ESS rules, and key other tax implications that are relevant to consider, including fringe benefits tax and Division 7A in the context of loan-funded share plans. And then following that, we will also do a brief run through of the ATO's recent guidance in relation to structuring of professional services practices and income splitting. But before diving into the tax technical, I thought I might dig out some recent AFR articles and take a little bit of a step back to sort of go through again, why a client or your firm might be interested in establishing an employee incentive scheme. And what we've seen is that there are probably three key reasons that firms would be interested in introducing an employee incentive scheme. Firstly, for employee retention. And as shown on this screen and in the first article, which is just from a month or two ago, a key business issue that we're seeing a lot of clients and other sort of businesses face is really sort of retaining good staff, right? Particularly with the cost of living crisis and other wage-related pressures. I suppose a key question we often get asked is sort of how can we encourage our staff to stay with us, particularly when we're not able to be paying, large cash sums today, to be able to keep them in our business. And as we will go through subsequently, employee incentive plans, so things like employee share and option plans, can often be quite helpful in this regard, particularly as they often include, quite a big sweetener for employees, but often with terms that might require, for example, the employee to stay with the business for 3, 4, 5 years to be eligible for those incentives. So that really keeps the employee engaged and keen to stay on with the business without any sort of upfront cash outlay from a business that may not have that cash flow to support that. The second reason we often see firms introducing an employee incentive scheme is to attract new talent, which is a similar sort of vein, but in terms of trying to bring on good new employees. And we particularly see that in certain sectors such as tech. So for example, I've got another article on screen, which is just from a few weeks ago, where Canva mentioned that it offered equity to its staff initially, and now that equity is worth a lot to employees given the success of the business. And we particularly find that in the tech sector, it's almost expected by employees that there's some sort of equity or incentive scheme in place so that employees are motivated and not just getting their sort of day-to-day cash incentive, but also getting some sort of incentive tied to how the business performs. And the final reason we typically see employee incentive schemes being established is generally where there's sort of a milestone or goal that the business is trying to achieve. So that might involve, a small company seeking to obtain external investment from a venture capital firm or other sort of strategic partner 2, 3, 4 years down the track, or a firm that sort of has been rolling on for a number of years but is trying to expand internationally, or potentially is wanting to be acquired by a firm or IPO or achieve some sort of objective in the sort of short to medium or even long term. And the way in which an employee incentive scheme can be beneficial there is that it sort of gives employees what's referred to as skin in the game. So, for example, you could tie an employee, or if you give an employee some shares, that, sort of incentivizes them to try and, help the business grow and potentially achieve that exit that the business is trying to go towards. Or these sort of incentive schemes can often have different hurdles and things tied to them. So for example, if the business is aiming to have a successful international expansion, giving an employee an equity interest or another incentive that is tied to those objectives can also incentivize them to better achieve those aims. So with that context in mind, I suppose that the second question we often get once a business has sort of established that they want to establish an employee incentive scheme of some sort is sort of how do we do so? And there's sort of two aspects to that we find ourselves often facing when establishing these sorts of schemes for businesses. And I guess the first limb that we often look at is sort of what does the business commercially want to achieve? And then the second limb obviously is tax and making sure that any employee tax or employee incentive scheme is not disadvantageous from a tax perspective, both for the employee and for the employer. So to ease into it, I guess the typical sort of simplest scheme that we see established is what's referred to as a cash payment, and that can be a bonus or what's referred to as phantom equity. And so this I'll go through quite quickly, but it's not particularly sort of complex, but effectively it just involves the making of a cash payment to an employee. So similar to your year-end bonuses that you might receive. These payments can be subject to conditions or performance metrics, and they can also be structured in a way to replicate the return that an employee would be had they been a shareholder in a company. So that's referred to as phantom equity. Typically, these payments are treated as salary and wages, and they're subject to superannuation and taxed in an employee's hands at their marginal tax rate, which is up to 47%. Now, the key benefit of having a cash payment employee incentive scheme is that typically this is the simplest approach. It's often very flexible in that there aren't sort of complex tax rules that need to be complied with. And they can be quite quickly implemented without too much work and too much sort of structuring or valuation or other sort of input required. However, what we do see is that businesses often will try not to make employee incentive structured in this way because having an employee incentive taxed at up to 47% typically isn't the most tax efficient methodology. So, given there are options that it may be significantly more tax efficient for employees and in turn may better incentivize those employees to the extent that it's possible, often we will guide our clients to consider alternative options. The final point noted on this slide is also that alternative structures may be preferred from an accounting perspective, and that's also just reflective of how these payments are reflected in a business's accounts, be it in the profit and loss as a payment of sort of salary and wages or a similar type bonus, or potentially, as an equity payment, which is reflected in the equity section of a balance sheet. So with that in mind, I suppose there are a number of different equity type arrangements that we see in place, each with their own sort of tax nuances. I might first pass on to Julian, who will go through certain non-cash employee incentive plans.
Great. Thanks, Soph. So we do tend to see a lot of non-cash based incentives in practice. And these take the form of either share plans, whereby you grant an employee equity in the form of shares in a company that carries on the business, or they could be options or rights plans that essentially give the employee a right to acquire shares in the employing company in certain circumstances. And we also see, apart from professional practices and other companies that might have employees to incentivize, we do see these used quite often in the startup space because obviously those businesses tend to be more cash poor and they're looking to incentivize and retain employees in a non-cash way. So we do see these kind of share and option plans used quite frequently in the startup or tech or now AI space as well. And I guess in terms of the issue of these shares and options and the terms on which they're issued, they can vary quite significantly. You can have shares or options issued for market value consideration. So the employee actually has to subscribe market value consideration to essentially buy into the business. Or shares or options could also be issued at a discount to market value. So instead of paying something for those shares, the employee might frequently pay no consideration at all. And I guess the advantage of shares or options over, say, some type of cash bonus is that the employee is more inclined to feel that they've got a kind of a share in the business. They've got an interest in the business, and in that sense, they may feel more incentivized or more aligned with the goals of the business because they are an equity holder. So putting tax considerations aside, very often one of the commercial drivers behind share or option-based plans is to actually give employees, I guess, a feeling that they are invested in the business via the holding of these shares or options. Now, there can be a whole range of conditions attached to shares or options. So, those shares or options might not vest unless the employee remains employed with the company for a certain period of time. If they leave before the expiration of that period, they might forfeit the shares or options. And similarly, there can be a whole range of restrictions on disposal or trading those shares or options. So, a disposal of options or shares might be at the discretion of the board of the employer, or it might be tied to some type of event, for example, a sale of the business or the shares in the relevant company. So there's quite a bit of flexibility involved with structuring share and option plans, and whether or not those are issued for market value consideration or at a discount to market value. But that's, I suppose, where the tax outcomes can be materially affected depending on the terms of these interests. Soph, if you could move on to the next slide. So, in broad terms, under the Australian tax law, there is a set of rules called the Employee Share Scheme Rules in Division 83A. And essentially, under those rules, if you grant an employee a share or option for something less than the market value of that share or option, that discount can be taxed up front to the employee. So they pay tax on it as if you'd paid them salary and wages or a bonus. Now, there is and that's whether the shares or options are granted to the employee or to, say, their spouse or to a family trust or something like that. So that discounts as a starting position is taxed up front. Now, the exception to that is where you satisfy the conditions for what we call deferred taxation. So you can push out the taxing point to a later point in time, but as you would expect, there are various conditions that need to be satisfied in order to achieve that deferred taxation. And in very broad terms, if we're talking about shares, then you basically need to have vesting conditions attached to those shares. So basically, and I'm talking about item 7 here, there needs to be a real risk that the employee may forfeit those shares if they don't satisfy those vesting conditions. And those conditions can take various forms, as I mentioned earlier. One common vesting condition we see in practice is the employee needs to remain employed with the business for at least 12 months or at least 2 years. But it's open to you to specify whatever time frame you like in terms of how long you want to tie the employee to that particular business. Otherwise, another type of vesting condition might be performance-based. So the shares might not vest unless the employee or the business meets certain profitability targets or performance hurdles, or it could be some combination of employment-based and performance-based hurdles. So to access deferred taxation, you need to have these some type of conditionality around the employee having to stay with the business for a certain period of time or to achieve certain profit-based or performance-based hurdles. So that's probably the main requirement around accessing deferred taxation for shares. In relation to options, there's a bit more flexibility. Basically, you can also have vesting conditions tied to employment, remaining employed for a certain period of time, or achieving certain performance hurdles. But there's another type of plan where you basically say that the option plan is subject to a particular provision in the employee share scheme rules, and you can achieve deferred taxation via that mechanism as well. Now, probably there's a few other points to note. deferred taxation is never available if the employee is going to hold more than 10% of the company. So just be mindful of that. If they're going to hold 9% or 8% or something less, that's fine. But deferred taxation is never available to someone who already holds at least 10% of the shares in the company or may acquire sort of more than 10% of the shares through the exercise of an option. So that's just something to be mindful of with deferred taxation. If we move on, so if you do qualify for deferred taxation, then essentially you can, in the case of shares, you can defer any taxing point until the shares are vested. So if let's just say if there was a condition requiring the employee to remain employed for at least 2 years, so following that 2-year period being met, then there's no risk of the employee losing the share. And then the other requirement is that there can't be any restrictions on disposing of the share. So basically, even if an employee remains employed for, say, the requisite period of time or meets the performance hurdles, you can essentially defer the taxing point until such time as there's no restrictions on the employee disposing of the share. So you can, for example, I guess, control the taxing point by having a disposal of the shares subject, for example, to approval of the board of the company. But there is a maximum cap. So 15 years after the employee acquired the share, that's the maximum period of time that you can defer taxation under these employee share scheme rules. And with options, you can see that, again, it depends on whether the option's been exercised. But similarly, once the option's vested, that is the employment conditions or performance hurdles have been met, you can control when the taxing point is by putting restrictions on when the option can be disposed of or when the resulting shares from the exercise of the option can be disposed of. And again, there's a maximum cap of 15 years that you can defer a taxing point. So very often in practice, we do see shares and options used to incentivize employees, and more often than not, those plans are structured so as to ensure that employees can access deferred taxation. So we might just go for a really simple example here. Let's just say you have a company and it's got a number of employees. And it basically says, look, I want to incentivize some key employees. What I'll do is I'll issue 1,000 ordinary shares to a particular employee for no consideration. And let's just say the market value of each ordinary share would ordinarily be $10. So the market value of the shares issued to the employee is $10,000, but the employee is paying nothing for them. So as soon as I mentioned earlier, as soon as shares are issued at a discount, and in this case, a discount of $10,000 because the employee is paying nothing, then the employee share scheme rules I mentioned earlier can apply. And the default position is that $10,000 would be taxed upfront to the employee unless the employee kind of satisfies these conditions for a deferred taxing point. And in this case here, we're told that the shares will vest over 4 years, so 25% every 12 months, provided the employee remains employed with the company. And furthermore, there's a restriction on the employee selling any of the shares, even after they're vested, unless the board of the Australian company approves that disposal. So when is the employee taxed in relation to the shares? Well, in this case, there is a risk that the employee will forfeit those shares. So if the employee um, left after 6 months, then basically they wouldn't get any of the shares. So there's what we call a real risk of forfeiture. So that's one of the requirements for deferred taxation. And the scheme also relates to ordinary shares, which is another requirement for deferred taxation. So even after the shares vest, let's just say the employee stays there for 4 years and all 1,000 shares vest, there is a restriction on the employee from disposing of the shares unless approval is given by the board. So that basically means in this example here, even though the shares have been issued to the employee at a discount, they won't be taxed on those shares until such time as first of all, they've stayed there for at least 4 years. And second of all, unless approval is given by the board for them to sell those shares. And as I mentioned earlier, there's a cap. If the employee were to stay there for 15 years, there would be a taxing point after 15 years. But before that, unless the board gives them explicit approval to sell the shares, they won't pay tax on the issue of these shares to them under this particular scheme. So let's just say that there wasn't any restriction on disposal at all. So as soon as the shares vest, the employees are able to do with them whatever they like. They can sell them or transfer them to someone else. So let's just say after the first year, we know that 25% of the 1,000 shares vest. So 250 shares vest, and the market value of a share at that time is $12. And then after the second year, another 250 shares vest, and the market value of each share at that point in time after the second anniversary is $15. So basically, whenever a taxing point arises, the employee is taxed on the value of those shares at that taxing point. So after the first year, because the market value of a share is $12 and 250 of the shares are vested and there's no disposal restrictions, they would pay tax at $3,000. And after the second year, they'd pay tax on $3,750 on the 250 shares that vest then. So when you're structuring these employee share plans, I guess the key takeaway is you need to understand what vesting conditions you're going to attach to the shares, like how long does the employee need to remain employed, or what profitability or revenue targets need to be met. And then second of all, what restrictions on disposal are going to be imposed on the employee in terms of how they can transact with the shares after those vesting conditions have been satisfied. Are there any questions so far on any of that? No?
There was one question, but I think your presentation has already answered it.
Okay. Great. Now, I mentioned earlier that you really only need to consider these employee share scheme rules if a share or option is granted at a discount to market value. So the employee is basically paying something less than the market value of the share or option. Now, the employee share scheme rules cannot apply if shares or options are not granted at a discount to market value. And there's probably two cases or two structures that we see in practice. Sophie's going to talk about a loan funded plan, but occasionally we do see this concept of what's called a premium price option, probably more in a startup context. And basically the theory here is if you grant options, say, for nil consideration, and the market value of a share is $10 at the time the options are granted. Now, normally you might say, well, if the options are, if the market value of an ordinary share is $10 and an option's granted over that share, what does the exercise price of that option need to be for the option to have a market value of nil? And this is delving into kind of valuation concepts here. But basically, it's not enough for the exercise price of the option to be $10 because the option under Black-Scholes and other valuation methodologies, the option has this kind of an intrinsic value and also a time value. So basically, in the income tax legislation, there's a whole range of tables which set out how to work out the market value of an option, depending on the exercise period, depending on the market value of an underlying share. And you can use those tables to work out basically what exercise price you need, what exercise period you need to get to a nil valuation of the option. And in this case here, if say you had an exercise period of up to 72 months, and the exercise price was $17, that would result in a nil market value for the option. So what I'm basically saying here is that you can structure options, usually with an exercise price or a strike price that exceeds the current market value of a share, to ensure that the market value of the option at the time of the grant is nil. And that basically means the option falls outside of the employee share scheme rules I mentioned earlier, and that the employee should only therefore be subject to capital gains tax when they sell the option down the track. Obviously, you kind of query whether it's commercially ideal to issue an out of the money option to an employee. But we have seen some kind of startups, tech companies issue these premium price options that have a market value of nil to basically ensure that employees fall outside of the employee share scheme rules on the issue of these options. So just something to consider in practice if you do have probably some clients who are in that startup or tech space. We have seen those types of startup companies or tech companies issue premium price options as a means of incentivizing their key employees or key staff. I'd also mention, and this is despite the name referring to a startup concession, this is actually more broadly available. And basically, as I said earlier, if you issue shares or options at a discount to market value, then the employee may be subject to tax on that discount, and then you need to satisfy the conditions for deferred taxation. But where a company has turnover of less than 50 million, it's unlisted, it's been incorporated for less than 10 years, it's an Australian resident company, then you can actually issue shares and options to key employees at a discount to market value and fall outside of the employee share scheme rules for the employee. So you can see there's a few conditions there. For shares, the discount can't exceed 15% of market value. For an option or a right, the exercise price needs to at least equal the market value of a share. And at least 75% of the employees need to participate in the event of a share issue. And there also needs to be a requirement that the employee hold the shares or options for at least 3 years and can't hold an interest of 10% or more in the company. But we've actually seen this concession used quite frequently, not just by startups or tech companies, but by businesses more generally. So, and as I said, the advantage here is that the shares or rights, even if they're issued at a discount, fall outside or are not subject to tax under the employee share scheme rules, which means on an exit, the CGT rules apply. The CGT discount could be available to the employee. It can be quite attractive for companies that can satisfy the requirements for this startup concession here. So definitely something worthwhile considering, and could equally be relevant to professional practices operating as companies that fall below the turnover threshold of 50 million, are incorporated for less than 10 years, and our Australian resident companies. So, I mean, this is just an example here. Well, let's just say Holdco is an accounting firm, and it has subco, so the operating business is in subco, but there's a parent company, Holdco, and Holdco sort of says, look, I want to issue options to some of my key employees. and it issues 2,000 options to 8 employees, each with an exercise price of $10, being the market value of a share in Holdco at the time. And let's just say Holdco's got no activities itself other than to hold the shares in Subco. Subco carries on an operating business, so the accounting business, with an annual turnover of around 15 million. And both companies have been incorporated for less than 10 years, for 5 years. And any employee who's issued the option is required to hold them for a minimum of 3 years. Now, of the employees who receive the options, let's just say one of them already holds 11% of Holdco, but and so the startup concession wouldn't apply to that particular employee. But the remaining 7 employees hold no shares in Holdco and will hold below 10% of Holdco even if the options are exercised. So in relation to the 7 employees who will hold less than 10% of Holdco, even if the options are exercised, the startup concession could very attractively apply here, so that even though those options are issued at a discount, they actually pay no tax on the grant of those options to them. So again, definitely something to consider for not just clients who might be in that tech space or startup space, but to businesses more generally. And we've used the startup concession for a number of privately owned businesses across a range of sectors and industries.
So I might then just move to loan-funded share plans, which are sort of a different variation of employee share and option plans. And I suppose the key distinction between these plans and what Julian has just been talking about is that these plans generally involve shares and options being issued to employees, not at a discount, but at full market value. And the upshot of that is that divisions 83A and the various deferred taxation conditions that Julian just went through are no longer relevant to these plans, which then makes these plans quite attractive to a lot of businesses where the Division 83A sort of deferred taxation conditions aren't appropriate. So, for example, if for whatever reason the relevant employer entity is not an Australian resident, or for example, if as mentioned by Julian, a key employee holds more than 10% of the business, or some other factor applies such that Division 83A is not the preferred sort of realm of taxation. Now the idea behind a loan-funded share plan is essentially involves a structure whereby, say, an employer gives the employee a loan of, say, $100, and that employee uses that $100 to subscribe for shares in OpCo or their employer at market value. And what that then means is that the employee has sort of skin in the game by way of shares in the operating company, but also doesn't need to sort of dig into its own pockets to be able to fund that, because the employer or a group company has provided it with a loan to cover that full market value subscription price. That loan is typically non-recourse or limited recourse. And what that means is that that loan is only repayable by the employee out of proceeds from those shares. So that might involve, dividends on the shares in OpCo or sale proceeds in the event those shares are sort of ultimately sold. And the commercial reason and benefit for that is that the employee then isn't exposed to downside. So in other words, if the value of their employer or that group goes downhill, say it goes to nothing and it all liquidates, the employee isn't sort of liable to repay that loan in full using its own proceeds. I suppose the purpose of this structure is to sort of give the employee exposure to upside, but ensure the employee doesn't at the same time get exposed to downside. Now, in addition to that, in a private equity context, what we also see is that these structures sort of give us a little bit of flexibility in terms of the terms of shares. And as mentioned, one of the key benefits of these plans over an 83A plan is that the shares issued to employees don't necessarily need to be ordinary shares, unlike the plans Julian went through. Rather, what we often see is that employees are issued a different class of shares, say Class A shares or Class M shares, and they can also have sort of special conditions to better incentivize employees. So, for example, in a private equity context, typically we'll see a private equity firm potentially acquiring a business or a target, and then either trying to incentivize existing key management or bring in new key management to sort of improve the business and make it grow in advance of a sale of that business, say 5-7 years down the track. Now, to help incentivize employees further, what we often see is that rather than issuing employees ordinary shares in OpCo in this instance, they're issued what's referred to as flowering or ratcheting shares. And what that might mean is that the terms of those shares include features whereby if in 5-7 years' time, at the time of an exit, the value of the business exceeds expectations set up front, the employee can get an upsized return over and above a regular ordinary shareholder, which of course sort of incentivizes that employee to achieve those hurdles or even more because they sort of get an upsized return. In that case, as noted on the screen, one key issue is that when you're issuing shares with interesting features, obviously they've got different terms to an ordinary share. And a critical aspect to this structure is that shares need to be issued for market value. So often we will see third-party or other valuations obtained when issuing shares to employees, particularly when they've got special features. But that's something that valuers are typically, very well across, particularly those valuers that do a lot in this space. Now, when issuing loan-funded shares, as mentioned, 83A is not an issue, but there are a gamut of other tax implications that we need to consider. The three of the main ones are set out on this slide. The first one is FBT. And just to sort of provide a little bit of a comparison, the Fringe Benefits Tax Assessment Act has a specific carve-out for employee shares and options issued under Division 83A that sort of makes clear that those schemes are not subject to FBT. But the same isn't necessarily here in the context of a loan-funded share plan, which, as mentioned, is outside the scope of 83A. Now, the key area where FBT may sort of ring alarm bells at first instance is where OpCo issues the employee a loan to acquire shares in OpCo, and that loan is interest-free. Now, obviously, whether the loan issued by OpCo to an employee is subject to interest at all or subject to interest at any particular rate or at the FBT benchmark rate is ultimately a commercial decision. But generally speaking, to sort of most incentivize employees, we typically see loans being issued to individuals sort of on an interest-free, non-recourse basis. And in that circumstance, I guess we all need to turn our minds to FBT, which typically applies where loans are being issued to employees below the specified FBT benchmark rate. Now, there is an exception from FBT applying when under what's referred to as the otherwise deductible rule, where a loan is being issued to the employee and the employee uses that loan to acquire shares in OpCo, and it has what's referred to as a reasonable expectation of dividends from its investment, so in this case, from OpCo. In that case, FBT doesn't apply. So there's sort of no FBT issue associated with issuing a loan at no interest or below the FBT benchmark rate to an employee. But there are sort of two key points to be mindful of in this circumstance. Firstly, for the otherwise deductible rule to apply, there needs to be a reasonable expectation of dividends from OpCo. So it's critical that the shares issued to the individual have dividend rights attached. And typically we will see, an OpCo sort of making a dividend at some point in time to the employee to sort of show clearly that, there is, dividends that are being paid to the employee. Though we have also seen sort of advisors take the position that, merely having rights to dividends attached to shares is sufficient, even if no dividends are ultimately paid. The other key point to flag in relation to FBT is that for that otherwise deductible rule to apply, the loan has to be to the employee in their individual capacity and not to related parties such as a spouse or a family trust. And as I'm sure the group is aware, typically with these structures and other structures, often executives and whatnot will have their own sort of family trust personal structures that they may prefer to house shares in OpCo in. And so as a result, typically what we see with these structures is often employees are given the option to either hold shares in their personal name or have shares held in the name of a family trust or other vehicle. If they choose to have their shares held by a family trust or other vehicle, then the loan that's issued to them is subject to the FBT benchmark rate, which their vehicle can pay to make sure that their employer is not subject to any FBT exposure. Otherwise, the loan to the employee can be interest-free. And in the terms of some of our loan documents, sometimes it's quite automatic in the sense that there might be one loan document that's sort of the same boilerplate issued to all employees, and automatically interest will switch on if the shares are being held by a family trust or other vehicle, whereas if the shares are being held by the individual in their personal name, there is no interest. The other point to be mindful of is Division 7A, which I'm sure the group is probably very well across and well versed with in your day-to-day practice. But obviously here we've got a loan from OpCo to an employee that becomes a shareholder. And as I'm sure the group is across, right, Division 7A may treat a loan from a private company to a shareholder as being a deemed unfranked dividend. Unless there are mandatory repayment terms, mandatory loan agreements in place, and so on and so forth. However, what we do generally see is that if an employee is not already a shareholder in OpCo, then Division 7A should not apply, because at the time OpCo issues a loan to the shareholder, at that point in time the employee is not yet a shareholder in the company. Therefore, Division 7A should not apply. But Division 7A does become an issue, and I'll go through some solves to that subsequently, where we're having subsequent issuances of additional tranches of shares to employees. So say, for example, a new CEO joins a business, they issued some loan-funded shares, and then 2 years down the track, the business wants to incentivize them further through further loan-funded shares. In that case, the second loan may occur at a time when the employee is already a shareholder in the company, in which case Division 7A could potentially be more of an issue. And the third point on screen is probably more of a point of note for the employee rather than the business itself, and that just relates to CGT and is one of the key benefits and key reasons why we often see these plans preferred by lots of companies and their executives. And that is that if the employee sells their shares in OpCo down the track and makes a capital gain, as hopefully is the case due to their contribution to the business, generally speaking, they should be entitled to claim a capital gains tax discount if they've, satisfied the relevant criteria for the CGT discount, primarily that they're an Australian resident and they've held their shares for at least 12 months. And that's one of the key benefits of these plans. It enables employees and executives to potentially, get a return that is taxed on capital account and potentially taxed at half the rate, as compared to a bonus or cash payment, or even a sort of amount that's taxed under Division 83A, as Julian went through. So obviously, if an employee is subject to tax at half, they obviously go home with more dollars in their pocket, and that obviously then turns into them being more incentivized from the scheme. Now, as mentioned, one of the key issues associated with loan-funded share plans is Division 7A, particularly where there are multiple tranches of loan-funded shares being issued to employees. But I just wanted to alert you to one solve that potentially could work and that we often do see in practice. And this largely depends on the group structure, but it's an interesting point from a tax perspective. So as noted before, Division 7A applies to, among other things, loans from private companies to shareholders of that company and associates of shareholders. But say, for example, we have this structure where we've got, say, an executive that's already got shares in Holdco, but Holdco also has a subsidiary, say, OpCo. Now, it may have a loan from Holdco initially, or OpCo, for its initial sort of tranche of shares, but 2 or 3 years down the track, the business might want to further incentivize that employee by issuing them further loan-funded shares. Now, in this circumstance, what we do see is that OpCo could consider issuing a loan to the employee. And even though the employee is already a shareholder of Holdco, as noted, Division 7A only applies to loans from private companies to shareholders or their associates, and the employee here is not a shareholder of OpCo, it is a shareholder of Holdco. Now, the quirk and the point to be mindful of here is that, as mentioned, we've got to see whether the employee is a shareholder of OpCo, which it's not, or an associate of a shareholder of OpCo, so an associate of Holdco. And if any of you have looked at the associates rules in the tax legislation, they're remarkably broad, but very broadly speaking, if the employee is not in a position to really control Holdco and does not have a controlling stake in Holdco, generally speaking, we wouldn't see that employee as being an associate of Holdco, in which case this is quite a neat solution to get around sort of potential issues under Division 7A. Neat solution being, that a loan is being extended from OpCo to the employee. And in that regard, typically we do see that sort of makes commercial sense as well, generally because OpCo is where the cash is within the business, as opposed to Holdco, which is typically a dormant holding company. And just mindful of time, I'll quickly go through a loan-funded option plan as well. But broadly speaking, this is very similar to the loan-funded share plan I mentioned earlier, except instead of the company giving the employee a loan to acquire shares in the company, it's giving an employee a loan to acquire options in the company that are issued at market value. Now, there are a couple of quirks between options and shares in the context of loan-funded plans. The first thing relates to FBT, and as previously mentioned, in the context of a share plan, there's the otherwise deductible rule, which may mean that FBT doesn't apply, but that's contingent on the employee having a reasonable expectation of dividends or a return from their investment, or sort of a reasonable expectation of deriving assessable income from their investment. But typically speaking, an option generally doesn't give rise to an entitlement to dividends or any other sorts of income. So typically, FBT will apply to a loan from a company to an individual, where that individual then uses the loan to acquire options, which is why in practice we typically see a lot more in loan-funded share plans than option plans, though in the right sort of circumstances, a loan-funded option plan may still be the preferred mechanism. As mentioned, there is still the Division 7A issue potentially, although noting that until such time as an employee exercises their options to become a shareholder in the company, they're not yet a shareholder in the company, and so there may be a bit more flexibility with respect to Division 7A. And the final point to note is CGT as well. And in that case, an employee can also sort of potentially benefit from a future exit with the preferential CGT discount. However, they do need to make sure they structure the exit appropriately. And the key point to flag there is that if an employee exercises their options and acquires shares in the company, and then 2 days later those shares are acquired by a purchaser of the business, they will effectively lose their capital gains tax discount there, because at that point in time they will have held the relevant CGT asset, being shares in the company, for 2 days in that example. So to ensure that the employee does get a sort of preferential CGT discount on exit, what we do typically see is that either we'll have the acquirer purchase the options of the individual, or prior to exit, the company will cancel the options, which essentially gives rise to the same economic outcome for the employee, but means that they're eligible for the CGT discount because the relevant CGT asset being disposed of is the options, which they have held for 12 months or more. And so very briefly, an example of a loan-funded share plan is here on screen, but it's quite similar to what I've sort of talked through previously. Basically, here's an example where we've got a company issuing a new Australian resident employee with a $10,000 loan, which they use to subscribe for shares in the company. Now, these may be of a specific class, so say M class, and they may carry a variable right to receive distributions depending on particular performance metrics. So that may incentivize an employee over the life of their investment because their dividend return from the company may vary depending on whether the company achieves certain sort of metrics. In addition, the terms of the non-recourse loan may prescribe that the loan is only repayable at a certain time, say on disposal of shares in the company. And what that then means is that if the company is ultimately, say, sold to an acquirer in, say, 3, 4, 5 years' time, if the company is acquired for a profit or the market value of the employee's shares increases from when they were initially issued the shares, then the employee will derive a gain, which they may be taxed on with a capital gains tax discount. Or conversely, if unfortunately the company is unsuccessful and the shares are sold for at a loss, the employee also isn't sort of significantly disadvantaged or disadvantaged at all because the non-recourse nature of the loan means that they have no downside risk and the loan is only repayable to the extent that they receive proceeds on the disposal of the shares. So it's quite a neat sort of solution or a neat sort of point, sort of thing in your toolbox that we often see implemented quite often in practice. And there is a lot of flexibility we see with loan-funded share plans to be able to have the plan sort of tailored to commercial objectives. I'm mindful of time, but I'll pass on to Julian regarding professional practice structures.
Are there any questions on the incentive content?
Not that we can see from the chat box.
All right. So if I move on, and obviously conscious of time, professional practice structures. So if we flip on. So, I mean, as a starting point, you've got to kind of consider the regulatory framework for professional practice, which can differ depending on the sector. In the legal industry, at least, legal services can be provided under any business structure, but a partnership can only have partners who are lawyers unless it satisfies the requirements for your multidisciplinary partnership. And at least from an accounting perspective, there's no restrictions on the legal structure that can be used by professional practice, whether it be a sole trader, partnership company, trust, or some combination of those. And then there are other limitations for, say, medical practices and the like. So I guess just as an opening comment, whenever you're structuring a professional practice, whether it's for yourselves or for your clients, just understanding whether there's any particular rules that govern the particular industry or sector. Moving on, So, I mean, your typical structuring considerations apply with professional practice structurings. You're kind of looking at retention of profits versus look-through, ability to split income, liability and asset protection, ongoing compliance costs, entry and exit. So if new, I guess, principals come in or if they leave, what are the tax consequences there? And just taxation more generally in terms of annual profits or losses. Do they flow through to the principals, or are they only recognized for tax purposes in the vehicle itself? So if I look first at companies, I mean, that's a fairly common professional practice structure that we see in practice. Obviously, the principals can be shareholders themselves, or you can utilize basically discretionary trusts. So each principal might have their family trust that hold shares in the particular company. And I guess the advantage of a company is that the taxes at the company level at either 25 or 30%. Any losses can be carried forward subject to certain recoupment rules. And obviously, there's the limited liability aspects of a company that make it attractive. having said that, individuals who are directors do have their various director duties under common law and under the Corporations Act in terms of acting with reasonable care and diligence, diligence and in good faith and so on and so forth. Next slide. So one structure that we do sometimes see in practice is, as I mentioned earlier, you could have a company. The principals could be employees of that company and they could receive salary and wages or bonuses. And then the shareholders in that company could be the respective family trusts of the principals, which then essentially receive dividends from the company with an ability of those trusts to then distribute those dividends to, say, a spouse of a principal or a corporate beneficiary. So this structure, to some extent, facilitates an ability to income split subject to the ATO's guidance on allocation of professional practice profits, which we'll come through to shortly. And is also useful, I guess, in terms of introducing new principles into the business, whereby they could subscribe for new shares, or if somebody's wanting to exit the business, they could simply sell their shares to another party or indeed another existing shareholder in that company. Moving on. So next slide. Sorry.
Computer is frozen.
It's frozen.
It has. Sorry.
So if you're still there.
Let me just replace that if it's all right. All right.
You've
Is
got
that
it?
the slide that you're looking for? Yeah.
Yeah, keep going. Thanks for that. If we could
That's all right.
move on
Is
to
that Nick?
So yeah, I mean, partnerships, another structure we see in practice, fairly common in the accounting and legal industries. And I guess the downside there is obviously joint and several liability of the partners, but there is flexibility in the distributions from year to year. So essentially, the framework for distributing profits and determining how profits are distributed amongst partners can be determined under the partnership agreement itself. So notwithstanding that the various state partnership acts provide for equal sharing in the capital profits and losses of the partnership, this can be varied by express or implied agreement, in this case, the partnership agreement. The key difference, obviously, from a company is that any income and losses flow directly through to the partners. So any consequences of any tax associated with profits of the partnership would obviously recognize at the partners level, as compared to a company which really just pays tax at 25 or 30%. So I guess there's downsides to a partnership, but they still remain a very common structure in practice, probably due to that flexibility around determining what the partners receive from year to year. We could just flip on to the next slide. Now, I guess an issue with partnerships is that when new partners come in, there is technically a disposal of each existing partner's fractional interest in the assets of the partnership to that new partner. So that could, in theory, trigger a gain or loss for the existing partners who are selling to the incoming partner. Having said that, there are typically ways to structure the partnership as goodwill versus no goodwill. So typically, under some partnerships, a new partner might not pay anything for the goodwill associated with the partnership, and therefore there'd be typically no gain or loss for the existing partners selling to the new partner. And if there is a gain, then potentially consider the availability of the CGT discount and the small business CGT concessions. Moving on. Now, this is again a very typical structure used with a lot of professional practices. So typically the partners as individuals or the principals will be partners in the partnership. And what will normally happen is there'll be a trust, a separate unit trust, which is set up to house the employees, the plant and equipment, and so on and so forth. And what will happen is the beneficiaries of that trust will typically be the family trusts of the partners. So all of the revenue from clients of the business will be recognized in the partnership, and then the partnership will pay a service fee to the unit trust or the service trust, and that trust will then distribute that service fee income to the family trusts of the partners. So effectively, you're then able to achieve an effective income split of some of the income of the partnership because of that ability to distribute to the family trust of the partners, who can then distribute to partners' spouses or corporate beneficiaries of those family trusts. So this is a structure that I've seen used in kind of the big and medium-sized accounting firms, and indeed smaller accounting firms as well, and used by a number of legal firms sort of in Australia, in the Australian market. And again, the ability to kind of shift income over to that trust is governed by the ATO's guidelines on allocation of professional firm practice profits, which I'll come to shortly. So moving on, trusts again can be used. Unit trusts could have the principals or their family trusts as unit holders. A trust is a flow through, so any income flows directly through to the beneficiaries. But to be honest, I don't see a lot of professional practices structured as trusts. I probably typically see them more as companies, as mentioned earlier, and as partnerships. But that's not to say you can use a trust. I've just typically seen companies and partnerships in practice. So if we move on to the next slide. So basically, and I think there might have been a presentation to this group a few years ago on the ATO's guidelines on allocation of professional firm profits. And basically, when you have structures with the sort of the partnership with the service trusts I mentioned earlier, or a company with discretionary trust shareholders, then obviously the concern of the ATO is they don't want too much of the profits of a professional practice shifted away from the principals to, say, their spouses or to companies under the control of those principals, because then you're effectively not paying tax at the right rate. And so basically this practice statement here, or this practical compliance guideline, was introduced a few years ago. And it doesn't just apply to accounting and legal practices. It basically applies to what they call individual professional practitioners, individuals who provide services to clients, right? And the practice guideline says it's included but not limited to the accounting, architecture, engineering, financial services, legal, medical, and management consulting sectors. So it's an inclusive definition. So this is obviously a guideline which you'd all consider in relation to yourselves as kind of accounting or possibly legal practitioners. or someone who's providing financial services, but can be equally relevant to your clients in a range of other sectors, as you can see from this slide here. And basically, the guidelines apply to these IPPs. There's a few other limitations on the guidance. Basically, the gateways there is that any arrangement to split profits needs to be commercially driven. And then furthermore, the ATO says it can't demonstrate certain high risk features, so non-arm's length financing, multiple classes of shares, exploiting differences between tax and accounting standards. But in broad terms, if this practical guideline applies, it sets out essentially a risk assessment framework to determine if you're kind of green, low risk, amber, medium risk, or red, high risk in terms of your allocation of profits structure. So if we could go to the next slide. So basically, there's three factors the ATO looks at, and depending on your score, depending on sort of the percentage or what range you sit in for a particular factor, you're allocated a score, and obviously a higher score is worse. And then once you total those scores, you're able to apply it to a particular risk matrix to determine whether you're green, amber, or red risk. So the first factor there really says if you're a principal in a practice, what proportion of your profit entitlement are you receiving personally? And what proportion is going to, say, your spouse or to your family trust or some other entity you control? So obviously, the greater the proportion of profit that is going to you personally, the lower the risk score. So for example, if you're receiving at least, say you're entitled to 200,000 and 90% of that comes to you personally, so 180,000, then your risk score is only 1. So the greater the proportion of profit that goes to you personally, or the IPP personally, the lower the risk rating there. The second factor then sort of says, all right, fine. You've only got some of the income coming to you. Some of it might be going to your spouse. Some of it might be going to a corporate beneficiary via your family trust. What's the effective tax rate? And obviously, the lower the effective tax rate, the higher the risk associated with it, the higher the risk score. And then the third factor there sort of says, looking at your remuneration, how does that compare to a benchmark, like for someone performing a similar role to you? Are you receiving, a similar remuneration to someone who might be performing an equivalent role in the business or a similar business? And again, there's different risk ratings there depending on the percentage of the remuneration in your hands that reflects a commercial benchmark. So if we flip on to the next slide. As you can kind of see, once you've looked at those three factors and totaled up the risk, if you're below 7 for under the first two factors, then you're low risk. If you're kind of 8 and above, then you're amber, and if you're at least 9, you're kind of considered high risk. For the first two factors, and you can kind of see that obviously there's other risk totals associated for all three factors. So it's probably easiest to demonstrate all of that through an example, which is on the next slide. So let's just say you've got a typical company structure. So it's an accounting firm. There's two principals, and they each hold their family trusts each hold 50% of the shares in that company, and they also receive sort of salary and wages from the company. And so we've got the two founding directors, and let's just say we're looking at Director A, and he receives salary and wages of 200,000 from the company, right? And his family trust also receives a dividend from the company of 200,000, which the trust distributes to Director A's spouse. So how does the ATO's risk assessment framework apply here? So if we turn on over to the next slide, you might recall there's the three factors. And the first factor looks at, well, you've got 400,000 going to Director A and to Trust A, right? And we know that 200,000 of that was paid to Director A directly as salary and wages. So 50% of his total entitlement is really going to him personally. And if you go back to that table, it's a few slides back, but you can revisit it in your own time. Essentially, the equivalent risk score, if you turn back here, so looking at proportion of the previous slide, the proportion of the profit entitlement to the IPP is 50%. So if you go to, you can see that equates to a risk score of 4, because the proportion of the profit entitlement is at least 50% and is less than 60%. So when you look at that factor, you sort of say, all right, I've got a risk score of 4. So if we go back to the example, the second factor you then need to look at is the effective tax rate. So if you calculate what Director A would pay in terms of tax on the 200,000 salary and wages he receives, that would be 56,338. So that's just applying your normal Australian resident tax rates applicable to individuals. And we know that Director A's spouse has also received 200,000 as a distribution via Trust A. And again, if you apply the marginal tax rate for Australian residents, that would equate to $56,338 of tax on that spouse. And so when you look at the total of those two amounts, 56,338 times 2 divided by 400,000, then the effective tax rate on that total entitlement of 400,000 is about 28.17%. And again, if you go back to that other table I mentioned earlier and you look at the different percentages here, so 28% tax rate, you can see it also equates to a score of 4. So the tax rate is more than 25%, but less than 30%. So our total risk score now is 8. So if you turn over to the next slide, just one slide, sorry, that table with the colors, you can see that against the first two factors, we're in the amber zone, which would be moderate risk, which basically means if the ATO were to look at this arrangement, they would investigate it further in terms of the reasonableness of the allocation of profits. So going back to that example, there's a third factor, but if you go over to the next slide, that factor is only really relevant if you can identify, I guess, a benchmark. So can you identify other employees performing similar duties, or are there relevant industry benchmarks that should sort of determine, is it reasonable for Director A to get $200,000 in his own name and the other 200,000 going to his spouse via the trust? But basically, you can ignore that factor if it's impractical to determine an appropriate commercial remuneration to benchmark against. So if we stopped there and we just looked at factors 1 and 2, as I said, the total risk rating would be 8, which would put this arrangement in the amber zone, which according to the practical compliance guideline, the ATO would look at this further. So that's basically the process that you need to step through when you're looking at your own practices and in terms of how income is shared perhaps to your family trust and to your spouse and maybe a corporate beneficiary of that trust, in terms of assessing the risk there of the ATO, whether you're green, amber or red. And it's a similar exercise that you then apply to your clients that might have structures in place to allocate income to their spouses, whether it's an architect firm or a medical practice or another legal firm that you're acting for. So if I move on to the next slide. So we've spoken about the conclusion there, moving on. So, I guess in summary, I mean, the key takeaways are look at the regulatory framework before you select a structure or advise on a structure for a client in a particular sector, and ensure they can use a company or a partnership. Obviously, professional firms can be structured in a way that allows for some level of income splitting to related parties, but you do need to ensure there's a sound commercial rationale for that. And you need to have regard to the risk assessment framework that we just went through by way of an example. Are there any questions on all of that? No? Well, we will be sharing the slides after this, so we'll send them through to Henry and Teddy to circulate to the group. But please feel free to reach out to myself or Sophie. Obviously, if you have any questions on management equity plans or structuring of professional practices, and obviously just more than happy to, if any questions come to mind, yeah, happy to sort of have another call with the relevant people or to send an email with some further guidance or comments.
All right,
But
so
thanks very much for having us.
anyone have any question? If you want to ask directly, you can unmute yourself and you can ask directly, or you can put in the chat box. Doesn't look like anything in the chat box.
No. Yeah.
No,
Yeah, no, there's nothing
the question is
in the
just a
chat box.
comment.
Yeah.
Yeah. Okay,
Yeah.
beautiful. No
All
worries.
right.
So yeah. So thanks, Julian and Sophie, for your time, expertise, and insightful presentation. Your valuable contribution is always appreciated. And thanks, Henry, for taking over that slides.
Thanks, Henry.
If
That's
you're not,
good.
yeah, I don't know what to do if not here, Henry. So
Yeah.
yeah, it's good to have a technical expert in our session. So that's good. So if any one of you need any further information, you can contact Julian and Sophie. The details on the screen, and I'm sure they'll be able to help you or your client further. So thank you all once again for attending tonight's session, and we hope to see you all back again in a month's time, and we'll still be online because the renovation of CV August takes longer than expected. So we're still going to run our session online until further notice. So until then, please stay connected, and we'll see you all back in next month. Thanks, everyone.
Thank you, everyone.